Welcome to the 8th episode of the Monthly Dirtcast. I'm Jared Dillian, editor and publisher of the Daily Dirt Nap, a financial newsletter for investment professionals. So the Monthly Dirtcast has a reputation of being kind of an offbeat podcast. We've had all kinds of guests on here. I think there's a bit of an arms race to have bigger and better and more famous podcast guests, and we, for the most part, have steered clear of that. But this month, I have the opportunity to interview a guy who is one of the original market wizards from the Jack Schwager book. One of the pioneers of the options industry, a guy who was trading options back in the 70s when people really hadn't even figured out how to value options. Our guest this month is Tony Saliba. We have a lot to cover, so we'll just get started. Welcome to the show, Tony.
Hi, Jared. Thank you.
So I just want to get it out of the way and talk a little bit about the Market Wizards book. Not so much what's in the book, but how you came across that opportunity to get interviewed and whether you had any idea that it would turn out to be as big as it turned out and people still reading the book, you know, decades later.
I had no idea at the time, and I'm actually still quite surprised how frequently, literally, definitely every month, but sometimes multiple weeks in a month, where somebody hits me on LinkedIn or another social media outlet to sort of revel in what they've read in Market Wizards and want to talk about it. And I try to engage. I mean, I'm flattered. Being the only options trader in the book, I guess I stand out from that standpoint. But also, I really started small trading and ended up sort of running one of the largest crowds on the floor through just, sheer discipline, I would say. How I came about the interview, which to me was even more of a interesting circumstance, it was the summer of '87, literally 30 years to the day, just about. And I was trading on the floor, and somebody from the marketing department of the CBOE came in and asked me if I would be willing to be interviewed on a piece about market making. And I figured it was a instructional self-help piece. I was on the board of directors. I was on a number of committees. I was really interested in giving back to the exchange that had done so much for me in the previous 9 years. So I said, yeah, I'll take the interview. This guy calls me. His name was Edmund Andrews. He was a freelance writer who currently, I believe, writes for the New York Times. And we couldn't line up our calendars. I usually would take August to go river rafting, different venues around the country. And then he was busy in September. And so we arrived at October 20 as a date where we both had free calendars. And I said, sure.
October 20th, 1987. Sounds like a good date.
But who knew, right?
Right.
Who knew? And we didn't have, there was no internet. We didn't have any calendars. We wrote everything down in little books. And we went about our business, went on my rafting trip with a bunch of traders from the floor. And the market started coming apart in late September, a lot more volatility. S&Ps were around 300, 320. And then the Friday before the crash, I get a call from this guy, Andrews, reminding me that he was going to be coming into town. He was based out of Washington at the time, to interview me on Tuesday. And I said, oh, okay, yeah, whatever. I totally forgot about it. I'm here, no problem. I'm trading. Let's do it. And once again, went about my business. Market falls apart on Black Monday. You know what's hitting the fan all over the place.
Yeah.
And the next morning, the guy shows up. Everybody is in panic mode. I mean, vols are in triple digits. People were having a hard time, reading their sheets. I didn't do that, so I had less of a hard time managing my position. I had a giant position in Teledyne and in the S&P 500. I traded SPX at the time. And this guy's at my door, in my office, and I said, okay, said one of my clerks, get a badge for him. Just come down. I'll try to get some time aside. I can't stop what I'm doing, but just hang out by the side of the crowd. I'll give you a trading coat. You can be a temporary clerk for me. And as I get a break, I'll come over and we'll talk. Well, this guy was a fox in the hen house, and he was there all day witnessing everything full on in the eye of the hurricane there, what was going on. He interviewed other people too. He stayed for a few days, watched how difficult it was to open markets. And fast forwarding, he ended up taking this small piece about market making and sells it to Success Magazine, who contacts me and says, this is unbelievable. Would you be interested in being our cover story for the January issue? And I don't know what that means, but why not? Okay. I was 32 and they come into my house, they do a big photo shoot. I'm on the cover of Success Magazine. And now to your question, I get a call from Jack Schwager, and he says, I'm thinking about doing a book, not a trading book, but not like the other books that are out, which were mostly, technical books, how-to books, a lot of analysis. But I want to do the human aspect, the human element of trading. And I want to put an options trader in there. I've got, big names, Paul Tudor Jones and others that are hedge fund managers and stock traders. Could I interest you in being in the book? And I said, okay, sure, why not? He comes into town shortly thereafter, and he says, I'm narrowing it down. There's 3 of you. I'm going to interview all 3 of you. And he chooses me, Jared. And I helped him edit the book. I helped him, sort of, with the language, because he wasn't an options guy. Jack's a futures guy. Yep. And I just figured it would be another obscure book. Well, every conference...
That's the thing about the book business. Nobody knows, what is going to take off and what isn't. People have just no idea. And that book, I don't know how many copies it sold, probably a couple 100,000 at this point.
Exactly.
Yeah.
And to this day, like I said, if I go to a conference or am a speaker on a panel, I have some typically young guy in his 20s or 30s who read the book while he was in school in finance.
I read it when I was in business school, when I was in San Francisco in 1998. I read it, Yeah,
I'm flattered, I'm honored and flattered, and I've helped Jack since then in different books. He wrote the intro, as you know, to my most recent book, and it's been a labor of love. It's he got us all together. I got to meet, I think, all but a couple of those guys in that first book, and that's a moment in time. Both those stories are locked into that period of time, but it was a great time. We were all floor traders at the time, or most of us were, and we hadn't been using computers yet. It was hand-to-hand combat, so it was a really interesting time.
So let's talk about a couple things. Let's talk about the hand-to-hand combat. Let's talk about the crash '87. What a lot of people, look, I wasn't trading in '87. I started in '98, so all I know is what I've read and what I've looked at charts. But what a lot of people don't realize, and you pointed this out, the market started to get kinky in September.
Yep.
And a lot of people think the market just crashed like this giant exogenous event that just randomly happened. But it didn't really play out that way, did it? People, some people later said they predicted the crash, but there were some pressures in the financial system that were building, and when it happened, I don't think a lot of people were surprised.
Well, so being a fairly risk-averse trader, particularly at the time, but I also was one of the lead market makers in the SPX. So the SPX was launched when the OEX was launched in late '83, but it was American style, like the OEX. The OEX was 100 stocks, SPX on the S&P 500, and a larger contract for institutions, and it never took off. So in early '86 or late '86, we relaunched it as a European style contract, and I was trading Intel, and I raised my hand. I said, I'll go in. There was not many of us. There was maybe 30 guys total in the crowd, probably about 20 market makers and 10 floor brokers, and we agreed to make tight markets, as tight as we could, with this wild index at the time. And there were players that coming in, particularly Goldman and Merrill, that were buying way out of the money. I mean, the index was at 320, and they were buying 220 puts. They were buying these puts. They were selling these puts just to collect a teeny, $6.25. And as market makers, we had to make markets. So I was buying them by the boatloads, literally thousands of them. And the market was getting hinky, as you said, in September.
Well, you probably thought that was just money down the drain at the time.
Totally was.
This is just like before the concept of tail risk, right? Like,
absolutely. We just thought we were doing them a favor. We started at maybe a quarter at $25 a contract, and quickly dropped the market to a teeny an eighth. And occasionally we would have some buyers come in and take us out of some of the ones that we bought. But for the most part, I probably had a couple thousand. I figured it was 12 grand. I chalked up to be doing my job as a market maker. The market was becoming much more volatile. And here's the bottom line on the crash. There was an aspect, and I'm sure you've written about, or you're definitely aware of, that so many of the big players bought into, Jared, and that was portfolio insurance. Okay? And this, for your listeners, especially your younger listeners, this was the notion that you've got a portfolio on, Mr. Customer, and it could have been a large institution as a customer. Don't you worry about it. When you want to hedge, just call us and we'll sell some S&P 500 futures, and you're all locked up. You'll be immediately hedged, or we'll sell half your position. You don't have to worry about it.
Well, it was an implied short gamma position, right? Like you sell on the way down and buy on the way up.
Yes.
Right? Yeah.
And everybody headed for the exits at the same time. And the S&P 500 was trading at, you can look it up, but it was a tremendous discount to cash. And it just fueled itself. And it got worse and worse and worse. And that Monday, I think it was probably trading maybe at 10 or 12 points discount to cash, and it typically traded probably anywhere from 4 or 5 to maybe 6 or 8.
For index ARB guys, if futures are trading 4% cheap to cash, that's a pretty good ARB.
And you couldn't sell enough stock.
Yeah.
The basket programs were very rudimentary, and the bigger players had them. The guys in the crowd with me were CRT, Susquehanna, Interactive Brokers, which was Timber Hill. So needless to say, it fueled itself. And if you recall the little puts that we all bought for a teeny, that day they closed at $20 a contract. So they went from $6 to $2,000.
So that 12 grand in premium was like 24 million, right?
Yes, well, but when I bought them, I had about 2,000. I think on the day of the crash, I had about less than 1,000, but like 800 or 900. Okay, and I didn't hold them to the very last minute.
Right.
I think when they closed that day, I still had maybe 300 or 400 of them, but I was hedging them and trading against them all the way down. I think I sold the first 1,000 maybe like out at an eighth or a quarter. So just like I got the rest of them for free. Yeah. So, you know, look, I wasn't a speculator. That was part of my position. And I was constantly scalping gamma to try to pay for them. I was long a bunch of butterflies that collapsed, but, you know, the whole thing worked out just fine and got Jack's attention, you know. So but it was wild.
So let's talk about when you first got into the business. What year was it? And, I mean, did you go right to the exchange floor? Did you go to the CBOE? Was it like 78, 79?
I spent about a little less than a year as a registered rep, a stockbroker, and it was, you know, Jimmy Carter, you know, a big day of volume on the exchange. You know, full-on exchange was 11 million, but we typically did like 7 or 8 million shares a day. I was a 22-year-old guy trying to sell economic development bonds to farmers, families. I hated it. And I asked one of the guys, and back then, Jared, you know, the older guys smoked cigars in the office. And, you know, one guy had his feet up smoking a cigar one afternoon in the spring of 78. And that's a story that you should hear what happened in April of 78. But I said, who makes all the money in this business? And he said, the guys on the floor. Well, you know, I was from Chicago. I caddied for bean brokers. And I said, well, I know those guys. And I just said, you know, I got to go back home and see about getting a job on the floor. So I hooked up with a guy that I had met. I was a broker in Indianapolis, and I met a guy down in Indianapolis that happened to be commuting, a market maker, and he took me on as a clerk. And this all kind of tied in because back then there were theoretical traders who were dabbling with models, okay? It wasn't pervasive. And most people were just calculating premium from an intrinsic, extrinsic point of view. There weren't a lot of
this is why I asked the question. I wanted to find out about this. I mean, Black Scholes had existed for... Were people even using Black Scholes? Like, how long did it... That came out in 74, right?
Black Scholes was pronounced, discovered, or written in 74. And in 78, there were literally, you could point to them, a handful of people who had adopted it. Because there were practical issues with it, Jared. You know, there weren't systems. There was a machine called the Monchik-Weber that you would log in to a mainframe with a Texas Instrument keyboard with a heat-sensitive printer, and you would type in commands to the mainframe. And I did this. I did this as a clerk for the guy I traded for, and it would print out a stream of values. And you know, most of the guys on the floor were cowboys. Nobody really cared about this. But there was one guy. His name was Walin Lee. And Walin was Taiwanese. He was a Thai national, and he was a little guy, you know, barely over 5 feet, and he was one of the biggest premium sellers on the floor. And so he had no family here. I was, you know, basically living with a bunch of guys downtown, and Steve, the guy I worked for, was commuting to Indianapolis. So 4 nights a week, I would go out to dinner with Walin Lee and Steve, you know, this 22-year-old clerk, trying to hang on, trying to learn. And these guys would talk about the efficacy of the model and whether the model was ever going to make it, whether it worked. And Walin Lee swore by it, okay? Steve was skeptical, and I was trying to figure something else out. So back then in '78, the guys were selling premium, literally an option, 10% out of the money with 1 day to go, they would get $1 for. And it was just highway robbery. Nobody knew what the values were. Retail clients were speculating. The last minute there would be a move, and they would come in, and everybody would just sell them at a really stupid price and collect the money.
What were bid-ask spreads like? And it seems like the public was just buyers, like they just hadn't figured out how to sell.
Well, the public were just buyers. They had definitely not figured out how to sell, and there were only 4 issues that had puts. Okay, so it was really half a game, and the markets were wide. They were, 50 cents wide, and in the out months they might be as much as $1 wide. And so, if you want to hear what I think is an interesting story. Most of the crowd had the same position on, and nobody traded with each other. Nobody wanted to cross the bid ask to trade with each other. They just traded whatever the paper was, whatever the order flow was that came in the crowd. So in April of '78, remember back in the day we only had 4 expirations a year, and they were either on the January, April, July, October cycle, or the, whatever it was, February, May, whatever cycle. And the big names were on that first cycle, the January, April, and October cycle. That's why if you look up volatility in the marketplace, the most volatile month is October, and the second most volatile month is April. So one of the big names, and remember, there were no indices. So IBM, Teledyne, Superior Oil were all proxies for an index. They were all proxies for the market. And when the crowd needed to participate, when the crowd became buyers, it came for these big names, Honeywell, Eastman Kodak, companies that are gone now.
Yeah.
Those were the bellwethers. So one of the companies, International Paper or something, came out with a huge upside. I got goosebumps right now, Jerry. Huge upside shocker of earnings. And they had to halt trading. And all of a sudden, the bellwether stock started ticking up. And this was expiration Friday, okay?
Everybody's short gamma out the wazoo.
Out the wazoo. And the guys in IBM all looked at each other, and there was silence. And for a moment, they realized we all have the same position. Now, around the perimeter of the pit were the stock clerks. And the stock clerks were there for hedging or speculating, whatever. And typically, most of the traders had their own stock clerk, different companies that were jobbers on the floor. And they all looked at each other, and now was a game of chicken. And one guy yells out, and I think his name was Kevin McGrath, and he said, hold on, let's all lock arms and walk together to the stock clerks. And Jared, they took about 3 steps together and then said, F it, and they just ran to their stock clerks to start going for stock, and it was a self-fulfilling prophecy. And IBM, and I think IBM was trading at 318, went through the 320 strike, or whatever that strike was. You know what it was? It was 260. Sorry. There was a saying on the floor. Sell the 280s and buy a Mercedes. And it went through the 260s, it went through the 270s, it went through the 280s, and these things were in the money, and these guys were short, and they were screwing themselves. It was the funniest thing to see these guys, like 8 or 10 of them, in locked arms for about 3 or 4 steps, and then they bolted. But, yeah, things were different, definitely different.
Yeah.
And theoretical values were scoffed at. And it was hand-to-hand combat, for sure.
So I want to talk about a couple things. This is bringing up, all kinds of stuff is popping into my head. And let's just do this one question, and then we'll take a break. I mean, first of all, the options world is so much different today, just in terms of how sophisticated it is, especially with technology. But if you look at a big liquid stock like, say Bank of America, at the money options are a penny wide and they're several thousand contracts up. And, these markets are every single strike is being updated as fast as microseconds. All the market making now has gone, I started on the P Coast in '99, and that it was still open outcry. The ICE started in 2000. And actually, it was the day that I started was the day that that single listing went away. That options became multiple listed. That was my first day in the business.
Oh, wow.
Yeah. So it's just become relentlessly more efficient, but in other respects, it seems more inefficient. I mean, just today, as I walked into the studio, the last time I checked my Bloomberg, VIX was printing at 9.56, right? Wow. And, about 10 years ago, the VIX was at 90. I mean, we've seen some pretty radical vol environments here. And not only that, nowadays you have exchange-traded products, ETFs or ETNs, that basically systematically sell volatility. So you can invest in a short vol product like XIV. So I guess here's my question. You look at this on a daily basis, and I've had a couple other guests comment on this, but what do you think that there is a short volatility bubble right now? Do you think that everybody has piled into this trade?
Well, it's funny because I went to dinner with my youngest brother, Paul, who is head of risk management for Goldman Sachs. He manages all of the risk analysis for their clearing business. So professionals trading options have to see one of his guys if they have a problem. And I asked him pretty much the same question, or stated a different way, Jared, is vol ever going to really take off again? And we came to the consensus, and he's got some pretty good inside views of what's going on. Most of the premium selling firms are highly capitalized, and the machines that do the analysis snap stuff into line intraday pretty quickly. So it's going to take an event. I'm not saying that you won't see vol in the high teens or 20s anytime soon. That'll happen. But on the day of the crash, volatility is traded at 300. Puts were going up while the market was correcting and rallying. So there just was not enough liquidity to keep things in check. So it's going to take an event. And like you said, there's more and more piling in. Now, having said that, spread trading is having a fantastic renaissance because, as you said, the depth and tightness of the markets allows individuals who are, plotting strategy to do multi-leg trades at a much lower cost and allow the product to really work for itself in a different way.
Yeah, I mean, you can do, in the old days, if you wanted to do, a butterfly or a condo, you were giving up all kinds of theoretical edge. Not to mention commissions. The multi-leg trades were just expensive to put on, but now it's precisely it's just virtually free. So you can do more sophisticated stuff. Yeah, and there's more sole props or individuals, higher end retail people doing as many as 12-sided trades that span multiple months and multiple strikes. So you have
you don't have the wild and woolliness of it, and you also don't have the, wide markets where you can sit and scalp all day. But if you have a view and you want to implement that view based on a lower risk, you can, use the options product and get in and get out a lot cheaper. So there's so much. Now, I have partners who think that your premise or your thesis of possibly a short vol bubble, they believe that. And it could. I mean, if one large market maker makes a mistake, has to run for the head for the hills, it could turn everything around.
Yeah, personally, I tend to think that basically anytime vol spikes, people run in and sell it again, a bit like whack-a-mole. And just because they've been conditioned to do that over the years. And I think what it will take is volatility has to rise high enough where vol sellers turn into vol buyers and people have to cover. So actually, I think there's like some gamma around the VIX around 25 or 30, if you know what I mean. I think above those levels, I think that vol selling will turn into vol buying. But we just haven't gotten there yet. We haven't had a big enough event to make that happen.
Yeah, you have panic and a turn tail, it changes everything. Absolutely.
Yep. So let me just take a quick break. I just want to let you guys know, if you're interested in reading my stuff, a good starting point is the 10th Man newsletter published by Malden Economics, and it's absolutely free. Free isn't free, as in doesn't cost anything. The name of the newsletter actually comes from World War Z, if you ever saw that. So to sign up, all you have to do is go to www.10thman.us. That's www.10thman.us. That's 10th as in number 10. It's a good introduction to how I think about markets, and there's plenty of funny stuff in there too. Just go to www.10thman.us. So now I want to talk about your book. This is the whole reason for having you on. So your publisher sent me a copy of your book, an electronic copy. This was months ago. And I don't get a lot of books. I get some. And, I mean, I didn't really have any expectations. And I open up this Word document and I start reading. And the first thing I'm reading is a discussion about carry on options. And it's explained to me in a way that makes sense. And I'm like, this is the book on options that I wish I read 20 years ago. I wish I had. This is what people need to be reading right now. So I want to give this book a really good plug. When I started on the floor, the gold standard for reading about options was Sheldon Natenberg, Option Volatility and Pricing. And I got my copy of that book in 1999. I underlined it, I highlighted it, I dog-eared it, I carried it around everywhere, carried it on the bus, on the BART train out in San Francisco, and I basically memorized that book. And I think that your book should be treated the same way. I think it's the new options Bible. So I guess my question is when you set out to write this book, I mean, there was some literature out there already. I mean, Natenberg is a very good book. But what did you set out to do that was different? How did you want to differentiate this book?
Well, first of all, Jared, thank you very much. I'm humbled and flattered for that intro and commentary on that. So my first few books, let me give a little background. When Natenberg came out, and I know Shelley, and when Natenberg came out, I thought, what do we need another options book for? Because we had Macmillan, So it was like, we read Macmillan, and, it told us what we needed to know, and then Natenberg came out. And, neither of these guys really mixed it up hand to hand as we did, which that plays a role. I mean, it plays a role in understanding relationships in options, because you didn't have a system. You were making decisions on the fly, calculating in your head, writing things on cardboard, tickets. So when Shelley came out with his book, I was like, wow, this is okay. Now I see why he wrote this book. It's pretty cool. It was much easier to understand than Macmillan. Macmillan was really dry, and Shelley's was a big step forward. I was working with the Options Institute at the CBOE, as a board member, just helping out, trying to, teach some classes and meet people and help with marketing. So we wrote a book then that I think is out of print now, but I wrote a chapter in this book. Bittman was involved too, Jim Bittman. And I wrote a chapter on the business of market making, and I described all the different types of traders that were in the crowd, and the scalpers and the spreaders and the market timers and the technical guys, and how they used options to do that. And that was 30 years ago, right? So over the decades, the next 2 decades, a lot of books came out, and I said in 2000, let's write a book that's more of a hands-on options workbook, okay, where people had quizzes and there were big margins, you can take notes, and it was very simplistic, and it might have been overly simplistic, but I learned a lot from those few experiences over the 20-year period there, that I said, okay, there's a lot of option books out. We're moving into a new market, and this is answering your question now with all that background. The Chinese were getting ready to launch options, and there's only a few option books that have been translated into Mandarin. So we set out, pretending there were no option books written yet, to write something that was more in lay terms on how to use options for the Chinese market. Okay, this was written completely to be distributed in Mandarin, and start from scratch, start fresh. So even though our book is not a beginner's book, you do need to understand some of the basics. Because it gets into a lot of detail that is, I believe, very useful, but it is really for lay people to understand without too much formula and too much leaning on having a system. Although everybody does have systems today. One more thing about my brother Paul, if you recall, Goldman's risk manager, a couple of years ago when the market was really coming apart for the most recent time in August of 2015, he called me up. I remember it was Friday, and he said, AJ, these people here, I had a line out the door of 30-somethings who didn't know what their positions were because their systems were going crazy. Vol was not computing, and they didn't know how to break down their position and look at relationships to get rid of the really low-risk stuff and isolate the, as we would call the remnants of your position where the real risk was. So we took both sides of that in this book. And, when I say we, I wrote it with my partner, Larry Schober, who has also written a couple other books. And we wanted to give guys and gals something that was really ultimately useful. Not that Shelley's isn't, but his is very much more for like the classroom, you know?
Yeah. What you brought up is a super interesting point about people not knowing their positions and getting tangled up and stuff like that. First of all, in addition to your book, and by the way, just the plug here is Tony Saliba. The book is Managing Expectations. If you want to learn about options, please get this book. So, the floors, the P Coast, the Philly, the Amex, Chicago, like those were training grounds for learning about options. They had thousands of people get jobs on these floors every year, from, you know, assistant market makers to clerks to stock jockeys. But there was a big market for people learning about options. And I think people learned about options the right way. Now that none of that exists. So if you have somebody at an investment bank or say a large hedge fund who's trading options, where did they learn about it? Well, they learned about it maybe in an MBA program, in a derivatives class, and they learned about it through the Hull book, and they learned all the theory, but they didn't learn how to make markets. And there's another book that's been long out of print, but which is really good for the stuff you're talking about, the Charles Cottle book. Do you remember that one?
Absolutely.
Options, Perception, and Deception. That's a really good one. And that's been out of print for, 15 years.
So Charles and I were partners for 5 years, 89 to 94, in a business that we barnstormed with our instructors and lab techs around the world. And we ended up teaching about 7,000 or 8,000 young men and women at different banking institutions, from Stockholm to Kuala Lumpur, Hong Kong, Sydney. And, Charles, who I'm still now in touch with, the risk doctor, he got those breakdown ideas, the pregnant butterfly and everything, from me. He just took it upon himself to write a book about it. And I totally agree with you that Perceptions and Deceptions was a really good book and useful book. And we are actually, Charles and I, have teamed up again together, and we are bringing out a multimedia, multidimensional, full-on gamified system next year that will help people completely visualize and learn options in a whole new way. And I just can't believe it.
Is this the thing that you were telling me about before that you wanted to talk about?
It's called Peak, P-E-A-K, Peak Edge, and there are 4 of us. It's a project that's been in the works for a little more than 4 years, and it is an opus. I mean, it is a man on the moon project, and Charles is one of the participants in putting the pieces together on this. When I said I wanted to talk about it, I mean, I kind of wanted to talk to you about it personally, Jared. Just, I can't say too much more than I did to your audience, but I promise if you want me to, I'll come back on around Christmas time when we have a lot more to talk about. And happy to talk to you personally about it, but I'm so excited. I spend a lot of my time on this because it will be I don't know if you know, but I created a simulator in 1988, a voice-activated simulator. It was the first of its kind. I worked with Dragon in 1988, and we trained thousands of people on a voice-activated simulator to how to trade options. Now we have it where it's electronic. We have the bots. We have AI built into this thing. It is really pretty cool. And happy to spend some personal time just bringing you up to speed. But I need to keep it a little more under wraps. And I hate to tease your audience like that because I know you have a great listenership. But I promise they'll be amongst the very, very first to when we unfold some of the great aspects of it. It's a big, like I said, man on the moon project. All
right. Well, we'll get back to you sometime in the future for sure.
Sorry to do that, man.
Okay, so I think I'm gonna spring this on you. I didn't talk about this before. So we're running out of time. But one thing I do with my guests is I do a speed round where I ask you a series of yes or no questions or short answer questions, and it's it's kind of funny stuff, pop culture, whatever. I just want to see where you stand on a couple things.
Sure.
And we'll start with a floor question. The Timber Hill guy, friend or foe?
Friend. For reasons you might not think, but I didn't necessarily think that they knew very much, but it didn't help me to be his adversary. And when the market was falling apart, we were lining up at his machine going, we'll buy those. We'll buy those. I'll buy 100. How many you got of those? I'll buy 100 of those. Ching-ching.
What is the best trading floor lunch when you were on the CBOE?
It was a deep fried perch sandwich from Brokers with a big thick slice of Vidalia onions, shaved garlic, and anchovies.
How many times a week did you get that?
Just on Fridays.
Fridays.
And I'm telling you, our crowd was unbearable after that.
Yeah, I can imagine. All right. Ocean's 11, Ocean's 12, or Ocean's 13?
The original Ocean's 11.
You like the original one?
But I also like the new Ocean's 11 too. I don't think I've seen 13.
I'm an Ocean's 12 fan. That's the very underground choice. And actually, the guy who produced all of them, Steven Soderbergh, that's his favorite too. I like Ocean's 12.
I'm gonna have to watch that.
Yep. Batman Begins, The Dark Knight, or The Dark Knight Rises?
Dark Knight Rises, then Dark Knight, and last Batman Begins.
Totally agree. Fooled by Randomness, The Black Swan, or Anti-Fragile?
Fooled by toss-up of Fooled by Randomness and Black Swan. I'm close personal friends with Nassim. Nassim's mother is a Saliba. I don't know if you knew that.
I didn't know that.
Yeah, and I don't want to get in trouble with Nassim, but in 1987, pre-crash, I had a deal with a French bank, and they introduced me to him, and he wanted to learn how to trade options, and I basically took him on the floor, and I was the first guy. We went to dinner. I was a single guy. He was a single guy, and he picked my brain. He wanted to talk about jump diffusion. I wanted to talk about relative pricing. So we've had a 30-year friendship.
Oh, that's very cool.
Yeah,
I've never met him.
Yeah.
No, that's not true. I have met him. I met him in 2002 at the Lehman Brothers building. He gave a talk. I did meet him once. If you had to enter a competitive eating contest, what food would you eat?
Indian.
You would.
I can't. I'm like a horse around Indian. What's that?
You would jam like 5 pounds of Indian food down your throat in 10 minutes.
Yeah, I would eat dal and dal makhani and chicken tikka masala. I would eat 10 pounds.
Oh man, that's funny. All right, one last one. Favorite Ed Norton movie?
Oh, X. What was it?
American History X.
American History X.
That is such a dark movie. I can't deal with it. It's too dark.
It's very dark. But you know what? I actually like Ed Norton. What was his most recent one where he? It's funny you asked that. How about Ed Norton on Modern Family?
Yeah, I didn't see that. I knew he was on Modern Family, but I didn't see that.
He played the lead guitarist of Spandau Ballet.
That's pretty good.
You got to check out the clip. It's really weird. It's funny though.
Well, that's all we got. We're done. Thanks for coming on. Is there anything else you want to say before we get going?
I can't wait to meet you in person. This was great, and I definitely will fill you in on Peak Edge and talk about the full awesomeness of it when you want and get a chance. But thank you.
Thanks.
And best, bona fortuna to your listening audience in trading. And I'm available if anybody wants to ask questions about this stuff, either on LinkedIn or, through you any way they want to do it.
Cool.
I'm passionate about options, man. That's all I can say.
Yep. Thanks a lot. This concludes the 8th episode of the Monthly Dirtcast. Thanks to our guest, Tony Saliba. Thanks to Blake Gerald for letting me use his track Punta del Este. And if you want to learn more about the Daily Dirt Nap, go to www